It's our Forex blog for June 20th, 2012. And like we do most days, we want to buy the strongest ones versus the weak and sell the weakest versus the strong. We statistically compare every currency to every other one on multiple time frames using multiple different methods. The histogram on the top is our real-time trend. Underneath that, we have the 15-minute, hourly, daily, weekly, monthly. The more time frames that line up, like the weak dollar from yesterday until most of today, until about 8:30, all the time frames are pretty much down, except for a little bit of counter trend move right here, which oftentimes resets the market to move additionally in the direction of a longer term trend. It's good once you see a weak currency like the dollar have a few hours of strength, because then when it resumes its downtrend, it's got room to run, whether it goes back down to the previous lows or breaks through them and moves even farther, and you can catch more pips. The histogram on the top, it's made up of 5 of our best tools, averages them together. 3 measure the direction, and 2 of them measure the intensity of the direction. So anytime you have the majority of currencies going up, in the Swiss's case, and doing so with incredible intensity, you're going to be at and above the dotted 80 line here. That's very significant. Let's go over our 3-step Forex trading system rules. The first step is, using the currency meter, find the strongest ones to buy. That's the strong versus the weak, or the weakest currencies to sell. That's the weakest currency versus the strong. And then step 2 is wait. Too many traders are impatient. You sit down, you can't wait to get in the market, you think it's going to go up, so you buy right away. You don't wait for a certain high probability pattern like a 30-minute sideways small volatility rectangle pattern, or a 38 to 50% Fibonacci pullback first. You need patience and discipline. That's why too many traders lose all their money. And they do it very quickly too, usually a month or two. So buy the strongest currencies from step 1 when you see a buy signal, when it shows up, and when price goes 1 pip over the previous bar's high. Now if the buy signal is in the middle of the range, you typically want to use this method. When it goes 1 pip over the buy signal's bar's high, you buy. If it's up near the upper containment bands, you might want to wait for the trailing stop to get hit first, flip down underneath price and turn green, then buy. The reason for that is if the market's in the middle of the range, it has more pips potential to go, and you're going to have a bigger win if the trade works. Whereas if you buy it from the high, you know that the odds of a bigger win are smaller. So for sells, you want to find the weakest currencies from step 1, and when the sell signal shows up, you want to sell it when it goes 1 pip below the previous bar's low. If the price is already near the lower containment band, and specifically the white 2.0 band, you might want to wait for the trailing stop to get hit and flip up above price and then sell. For exits, smaller traders and inexperienced traders, those with under $25,000 or $50,000 accounts, should use the trailing stop for all exits. The bigger accounts you have, the more likely you are to be an experienced trader, and you might have a few trades going on at the same time. You may also have, more than likely you have much bigger lot sizes. It's psychologically easier to trade by exiting half your trade when the market stalls at the first area of support and resistance. So here are the key areas of support resistance, and my number 1 is the Fibonacci profit targets. Most of the time the market stalls somewhere between the 1.382 and the 1.618. Probably 70–80% of the time it does not go above the 1.618 by more than 5 or 6 pips, so you want to exit your trade at that level. Also, markets rarely ever go beyond the 2.0 fib level. Now, fibs should be drawn on swings of 25 to 35 pips or more. If you draw fibs on a 10 pip move, then the 2.0 level is just 20 pips away. It's, a strong market or a weak market will go more than 20 pips. So when I say this, markets rarely go above the 1.618 or, almost never go above the 2.0. I mean when the fibs are drawn correctly. If some idiot that doesn't know how to use the fibs draws them on a 12 pip range or a 6 pip range, then they're worthless. That's not how you draw them. So watch our Fibonacci videos to learn how to draw. And they're real easy, and you can see it in today's blog video as well. Okay, so this is our sortable currency meter. That's one other thing I haven't shown today yet. When you sort these from strongest to weak, it's going to show the strongest currencies on the top right now. The dollar is very strong. The Swiss, second strongest, and that's just on the last hourly trend. The weakest ones are New Zealand, and the yen is the weakest. So basically the euro is relatively strong. the yen and the New Zealand are pretty weak. You could trade, look for euro yen sells. I'm sorry, buys. Buy the strong euro versus the yen. Yen's always on the bottom, euro's always on the top. The other pairs, are on the top sometimes and on the bottom other times. So let's look at this. I'm going to put this in the order I like, with the dollar and yen on the top. You can see the yen is clearly weaker than the dollar today. Looking at the New Zealand earlier, it had a lot of strength from about 330 all the way up to about 8. The hourly trend was still down, the daily trend was down, but look how strong the weekly and the monthly trend is. So the longer time frame trend is up, and so when you see some strength coming in, it certainly makes sense to buy it versus one that's weak on all time frames. So let's look for New Zealand yen buys, and you can see this broke out from underneath above the hourly here, found support between the 50 and the 200-day moving average, broke back above the hourly moving average. This buy signal right here is an excellent one. This is a perfect example of why, if the buy signal is in the middle of the range, not up here near the upper containment band, you might want to wait, or in the middle of the range like this, you buy it when it goes 1 pip over the high, right here at 95. And you can see it continued on up. You have your fib off of this area. This is the fib area. Now, if you got in there and you kind of waited for the fib area to get hit, that's fine. You got in around 96. You got out at 18. You made a little over 20 pips on the trade while risking, this is a 5 pips per bar chart. You're risking 5 pips plus 1 pip padding plus your spread. Your loss, if the trade doesn't work, is much less than your win here. Or if you got in and just used the trailing stop to get out, you had a small win. Seeing that this was one of the strongest ones, when it breaks back above the trailing stop, you could have got in here again. This trailing stop's a little tight on here. You didn't make that much. The fib targets on some of the pairs that are a little bit more choppy than other ones, the euro dollar and the pound dollar, euro yen, pound yen tend to have much more smooth and bigger trends. Some currencies tend to chop more. You might just get into these trades, and when it goes up and goes sideways here, you take your 10 or 12 pips, buy the pullback, go sideways here at the previous day's high, make another 6 or 7 pips, whatever. Let's look for some other examples. The more time frame trends that are up, the better. Here's the euro. Starting today, it was strong. The 15-minute trend's up, the hourly trend's up, the daily trend's up. However, the weekly and monthly trend's down. But if you're going to, buy the euro, at least do so against the yen, which, the weekly and monthly trend are down also, and they're weaker. They have weaker weekly and monthly trends than the euro does. And it can take a week or two before the monthly trend shifts up. So if you're intraday trading and looking to hold for 30 minutes to an hour, you want to make 20 to 30 or 50 pips, the weekly and monthly trend aren't as important. But if you're going to, buy one that has a weekly and monthly trend, at least do so against a currency that has a weekly and monthly trend that's even weaker than the euro. So let's look for euro yen buys. We're going to scroll back there earlier today. Notice the price is above the hourly right here. And this is a Fibonacci retracement area. It's going to be resistance. I would really wait for it to break above this major resistance area before you get in. And you might get into a trade here and lose 10 pips, get back into a trade here at 35, and notice it got you out right here at 69, 70. You made 35 pips on that trade. So if you lose 8 or 9 pips and then you make 30 plus on the next one, and here's a good example of how to draw the fibs. A nice decent sized swing, which is 60 pips. Our fib tool tells you the price at the high and the low, the fib areas, fib retracement areas, Fibonacci profit target levels. And in this case, it went up to the 1.382 and stalled. I would have been out of the trade right there. Noticing how strong this is, though, I might have bought this pullback here. And this is one where if you really believe in the trade, buy it when it goes 1 pip above the bar's high. And it really stinks to get out of a trade here and then get right back in. But when the currency is up on all time frames, because the euro's weekly and monthly trend are down, but the yen's is even more down than this, you can see that all the time frames are up because the euro is stronger. You get in right here, and you never know where it's going to stall. You could always exit here with a few pips, comes down and goes sideways, breaks out. I'm going to be showcasing next week our volume profile charts. which lets you look inside the bars and see where all the activity happened inside each bar. And when you bring it up on a 30-minute, hourly, and 4-hour chart, you really get to see where your real support resistance in the market is. And it will help you decide whether you want to take a trade that's a little bit riskier like this, buying up near the highs. Fibonacci profit targets, I do these each night. This is a fib profit target from yesterday's move up, and it's, especially when it's above our upper white band, it's likely to be the end of the up move. So, if you bought right here and you want to wait to see where the fib target is, notice where it went, right to the 1.618. And this is what I mean. Most of the time the market doesn't go above, and it looks like it went 1 pip above. It doesn't go above the fib target. But I drew this fib on a swing that's 55 pips. See, our new Fibonacci profit target level shows you how many pips. See that? This is a 25 pip move. That's not that very big. That's not very big. 25 pip moves, don't really contain price. Now, one last thing to go over while we have this chart up. A previous swing like this, notice the 2.0 level. It ran into some major steam right there at the 2.0 level. Most of the time, these don't get broken. And it didn't really get broken. It hit it, pulled back, hit it, went sideways. When a resistance area gets hit and goes sideways, that is bad news. It's a continuation pattern. It's very much likely when it breaks out above to go to the next level. And, the more waves it goes up, the more likely it is to find resistance at a smaller fib area. And that's what I typically do. The earlier into the beginning of a trend and in the middle of a trend, I like to draw fibs on big moves. Near the end of the move, when I think, it might make one more wave up, I like to draw fibs on tinier moves, in this case 34 pips. But notice, when it goes above the 1.618, usually that's the end of the move and you want to get out. And you can even start looking for some counter trend trades up there, but I wouldn't have sold this one because it's just so strong.